The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A second straight week of gains for global stocks confronts the reality of earnings and interest rate decisions. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
I'm Alex Steele. Really a fizzle today at the end of the day.
I thought we were going to set up for, what is it?
Will be the second
record high.
It will be the second record high, but no, we're definitely not near that here. The S&P is down by 0.4%. The real underperformer are those chip stocks led by Texas Instruments, hence that earnings story that Romaine's talking about. You can see here the NASDAQ underperforming and the SOX index, the semi-index, down by over 2%, Romaine.
Yeah, and the price action today really indicative of the risk to sentiment out there. We talk about an S&P and global stocks sitting on, yes, a second straight week of gains, but a second straight day of losses in chip stocks, of course. Those are the heavyweights. That's really souring the mood. It's the first drop in consumer sentiment in 6 months, also souring the mood, as is preliminary PMI data showing a miss for both services and the composite components. Put a pin in that, because that shifts us to next week when monetary policymakers in Europe and, of course, right here in the U.S. are going to make their first interest rate decisions of the new year, and concern abounds across markets. And that was on display at Davos as it closed it out this week. IMF chief Kristalina Georgieva, as well as BlackRock CEO Larry Fink, both acknowledging that for all of the efforts by central banks to tame inflation, that job is far from done, and rate increases certainly a possibility down the road. And for equity investors, that means there's more pressure than ever on those big tech stocks to keep this rally going. Meta, Microsoft, Tesla, Apple, all scheduled to report earnings next week. Almost 20% of the S&P waiting. And, well, don't really look at Apple. That's going to be the one to watch, though. That stock firmly in correction territory, down 14% from its all-time high. And today, at risk of closing below its 200-day moving average, Alex, for the first time since May.
Which is amazing that the S&P has actually held up so well despite that. So let's look at the macro side of it. That's the earnings side, so important, as Romaine was talking about. And then we get the Fed next week. This is a great sentiment indicator helped from BI. So the red bars here mean that the Fed opening statement is looking at a more hawkish score. The blue bars are a more dovish score, and the white line is the overall opening statement sentiment. And you can see here, really, ever since September, we've seen a slight climb higher in terms of the sentiment to a more hawkish bent. And that was before we've seen any sort of policies from President Trump. And we know from the last minutes, Romaine, that some Fed officials specifically were looking at the risks of, say, tariffs when it came to their monetary policy forecast. And this week will be even more interesting on that front. Do we see even more hawkish rhetoric then, Romaine?
Yeah, that is the big question. Let's try to get some answers out of our first guest here on this Friday afternoon. Jerome Schneider joining us, Managing Director and Head of Short-Term Portfolio Management and Funding with Pimco. Jerome, I know you keep a close eye on rates, and I'm sure you've noticed rates have kind of been stuck for a while. A lot of folks really, I don't know if they're indecisive or maybe just a little bit scared to take big bets. Are you taking big bets right now on directionality?
Well, most of the market is in a wait-and-see approach, and that's likely what we're going to ultimately see from the Federal Reserve as well at next week's meeting. And ultimately, what you allude to as a fizzle or just sort of a more latent environment for risk-taking is really one where we're sort of taking a look, digesting what we have in the economic data, understanding that the initial conditions for the economy are actually still pretty strong, with growth and growth higher than expected, unemployment lower than expected, and then more importantly, just seeing where policies and how they evolve over the next quarter or two is really sort of in the back pocket of not only investors, but also central bankers sitting in the Eccles building in D.C. And so from that perspective, the Fed is actually fortuitous that they can take a sit back and wait approach, at least at this meeting and going forward. And the Fed might actually be on hold for this foreseeable future as they sort of digest the difference in evolving situation with inflationary numbers, growth on the other hand, and ultimately see how the policies take effect later on this year once we see that show up in the data. So for this perspective, it's understandable that rates markets, even risk takers in the equity markets are going to take that wait and see approach. But yet we find it a pretty compelling environment for investors to sort of take a reset and understanding that, yes, there's some uncertainty, but there's still some great opportunities out there. And we should take and survey the landscape for what the fixed income environment and specifically the rates market has given us over the past 6 months in terms of higher yields.
Talk about some of those opportunities, Jerome, that you and your team over at Pimco are taking advantage of.
Yeah, and I think this is one of the things is that we would urge investors clients, advisors, consultants to take a look at their entire portfolio composition, not just the fixed income in isolation, not just the equity markets in composition. And while we do feel that there's an opportunity just in terms of higher income, specifically in bonds, perhaps in the 5 years and beyond sector, the reality is that most investors are still going to want to think about how to manage risk, how to manage volatility, especially given some of the policy uncertainties, both positively and perhaps negatively, that are out there. And so the outcomes are perhaps not as clear-cut as people would like on the investing front, but the way to balance that is have some ability to earn some income along the way, again, at higher nominal yields, but also positive real yields, inflation-adjusted yields, which are still quite attractive. And so we would urge investors to take that discussion. Mm-hmm. And should the economy prove to be softer than normal, well, you're going to see some capital appreciation in bonds as they rally. So we recognize the fact that this is a much different environment than we had 2 to 3 years ago for that uncertainty, and even different than the first Trump administration. And so understanding that landscape and how this perhaps creates an opportunity for some capital preservation and income is pretty compelling for investors right now.
Where on the curve, Jerome, do you like that?
Yeah, so we're looking pretty much at the 5-year point and in. We do recognize one thing, Alex, is that, as I mentioned at the top, this is a wait and see type of market. And we do recognize that there are some investors, bulk investors, in fact, investors totaling about $7 trillion in assets still sitting on the sidelines in cash and money market funds. So there's a good amount of people who simply want to stay in those shorter maturities. But I think it's also important, Alex, to recognize that, not all cash is the same. The attraction to be in T-bills and money market funds has actually dissipated quite a bit. And you're seeing a greater dispersion in terms of yield opportunities for that cash. So no longer is it as easy to earn 5% in Treasury bills. In fact, it's closer to 4% or below. Demand deposits, certificates of deposit are in the 3% type of range. So that dispersion means you just simply need to take a more active look out of cash, look at the front end of the yield curve, and you can still find opportunities to manage cash in a highly conservative way in that 5 to 6% total return realm without taking a lot of interest rate risk. So we understand that there is a bifurcated discussion going on with many of those people still on the sidelines, unfortunately.
What's so interesting, though, is that if you like sort of the 2 and the 5 year, that's where you're going to get the most exposure to the Fed, but you're kind of leaving aside that long end, which has much more risk when it comes to, say, policies in D.C.
Yeah, and I think that's exactly the point is that, while there is a risk that the Federal Reserve continues to cut rates, and that obviously leads to some capital appreciation for bonds, or there's an outlier that perhaps they eventually increase rates should inflation be stickier, the reality is it's a more measured response. So you can take a look over the course of the next few quarters and say the Fed's activity is probably more diminished, more pensive, more constrained than we witnessed back in 2023. And that should give security to investors in that fixed income space. And so from that perspective, we do favor the front of the yield curve. And as you also alluded to, perhaps the impact to greater fiscal policy comes out the curve in the 10 years, 20 years, and 30-year issuances, which perhaps could demand more term premiums. So we do believe that the yield curve will continue to steepen. And as a result, while we do find bonds attractive in that front-end space, we do recognize that there could be some repricing further out the curve because of those fiscal considerations that might come to fruition over the course of the next year with policies.
All right, Jerome, always a great conversation. Have a wonderful weekend. Jerome Schneider, Managing Director and Head of Short-Term Portfolio Management and Funding with Pimco, putting rates back in focus ahead of a big week for monetary policymakers next week. In the here and now, a refocus on the markets and the best performing stock in the S&P 500. NextEra Energize on a big news out today, a conversation about the company's latest partnership. A conversation with John Ketchum, NextEra Energy CEO.
And we've got big energy on the close today. Venture Global's CEO will be joining us on the heels of the company's IPO to discuss the future of LNG across the globe.
And a conversation about community banking, a conversation about housing from the lender's perspective. Kevin Cohee, CEO of OneUnited Bank. That conversation coming up a little bit later in the show. Stick around. A lot more coverage coming up here on The Close. This is Bloomberg.
Shares of NextEra Energy seeing the best rally since October of 2023 after earnings and announcing $120 billion in capex over the next 4 years to grow their fleet to 121 gigawatts and provide more energy to American homes and businesses. NextEra also announcing a new partnership with GE Vernova to build natural gas powered generation solutions. Lots to get through. Joining us now is John Ketchum, President and CEO of NextEra Energy. John, good to see you. Great quarter. Clearly the market likes it. Is this need, the demand, the CapEx, is that all an AI data center story right now?
Well, I'll tell you, Alex, power demand is stronger than it's ever been, really since the last industrial revolution. We're projecting power demand to increase sixfold over the next 20 years compared to the prior 20. And it's coming from all sectors. It's not just AI, it's semiconductor chip manufacturing, the electrification of industry and manufacturing as we advance an America First agenda. It's utilities that are experiencing population growth in certain parts of the U.S. It's coming from everywhere.
And of course, with your regulated utility in Florida, that makes sense. That's where a lot of people are moving to. John, that $120 billion CapEx for a company like yours is huge. Where are you going to get that money? Equity, debt, ratepayers?
Well, I'll tell you, I mean, we raise that capital, across the board. Number one, our assets throw off a lot of cash. We were able to grow cash flow from operations at about 17% during 2024. We also have a very deep bank network. We bank with about 104 banks around the globe. And we also have excellent relationships, not only in the public capital market, but in the private capital market as well. So there's no shortage of opportunities to attract capital to be able to support that spend, given our track record here at NextEra Energy.
Hey, John, I am curious as to how much help or how much of a tailwind you've gotten out of the Inflation Reduction Act and some of the tax cuts, and whether you factored in the potential risk that the new administration might scale back some of those programs.
Yeah, so when I look at it, right now we need power, and we need power more than we've ever needed power, and it's here right now. We cannot afford to wait. We need electrons on the system, and those electrons have to come from all sources of generation: renewables, battery storage, gas-fired generation, and nuclear. Having made our announcement today with GE Vernova that you just showcased, that framework agreement, and then second, our announcement today that we've made a filing with the NRC to seek an advanced operating license to recommission that plant. We've got a little bit more work to do around attracting a customer, but we're going to need electrons from all sources of generation. And one of the main points that we're trying to get across is the timeline to bring on these generation resources is not the same across the board. Renewables are here today and can be interconnected to the grid today. Wind can be built in 12 months, battery storage in 15, solar in 18 months. Gas is a more complex and elongated development cycle. Yeah. It takes 4 or 5 years to bring it online. So we're not really going to see a contribution from gas-fired generation till 2030 and beyond. And nuclear, besides the recommissioning, is even further than that, probably the mid-2030s to the latter part of the next decade. So we absolutely need renewables right now. We're getting a lot of support from Republicans around IRA and keeping the tax credits.
Okay, so John, that means that your estimate is that the IRA tax credits for solar and wind don't go away.
My estimate is that they don't go away. Okay. Why do they not go away? We need those electrons, and a lot of that $120 billion investment that you talked about at the beginning, 80% of that's going into Republican states, and it's going into Republican states in the form of new renewable investments, new manufacturing investments. A ton of jobs are being created. It's establishing a property tax, base that's worth billions of dollars that are revitalizing rural communities. And so it's a huge American domestic industry that will continue to advance, and electrons we need on the system today.
So, John, to that point, if you need to build all the stuff, you need the stuff. So what would an impact of tariffs be on your ability to build wind and solar and battery storage?
Well, I'll take wind, for example. We buy our wind turbines from GE Vernova, and 90% of a wind turbine is made right here in the USA. And so that's an American, product and commodity. On the battery side as well, we have been able to work towards sourcing almost all of that in the United States And then when I turn to solar panels, we source some of it in the U.S. and then some of it we source from around the globe. Of course, we do not source any solar panels from China. The industry has not been doing that since back in 2013. And so the supply channels that we utilized are globally diversified.
John, I don't envy your job as a CEO of a company that's so layered like this, particularly when you talk about how long it takes to get some of these projects out and, of course, the disconnect between some of them. As you manage that going forward, I am curious as to, do you see or do you prepare for a potential plateau? We talk about this exponential growth in energy demand and energy needs, but at some point, I would think it would level off, or is that not the case?
I just don't see it with all the power demand that we have. And what's great about what the new administration is doing is they're really shining a light on the need for power in this country. And they're unleashing energy, and they know that we have to have a dominant American energy economy here in the U.S. And so I expect a lot of the things that this new administration will move forward. Permitting reform is a great example. Will really help to advance in all of the above strategy, because we just need electrons and we need them on the system now. We can't afford to wait. Time is money, and it's going to have to come from all sources of generation.
All right, well said, John. That's why you're the CEO. John Ketchum, President and CEO of NextEra Energy, having a phenomenal day. In fact, best performer in the S&P on the day and having its best day. I was just taking a look in 15 months, Alex. All right, when we come back, we're going to take a look at another stock that's actually been doing pretty well, at least on a weekly basis. Restaurant Brands having its best week in about 6 months. Guggenheim Securities seeing reason to maybe buy more. That's coming up next in our top calls. This is Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations, and we start off with Twilio, an upgrade to outperform over at Baird. This after the software company released preliminary fourth quarter results that topped expectations. That filing came just a couple hours after it had ended its investor day, which analyst William Power says left him more confident in the company's ability to drive double-digit revenue growth. Those shares having their best day since 2020. Next up, Calvin Klein, the owner of PVH, cut to neutral over at JP Morgan. The analyst citing concern about sales growth. He also expects PVH to face gross margin headwinds related to its Tommy Hilfiger brand and the recent decision to sign a licensing agreement with Revman to manufacture and distribute those items in North America. Those shares down 6%. And let's end things on Brinker International. The owners of Chili's and Maggiano's downgraded to sector weight over at Key Bank. This is mostly a valuation call, with the shares almost quadrupling over the last 12 months. The analyst says that's well beyond what we originally thought to be a realistic bull case scenario. A pullback today of about 3%. And those are some of our top calls. We are going to stay in the restaurant sector and turn to fast food company Restaurant Brands and its valuation. But it's the flip side of Brinker. Guggenheim Securities upgrading to neutral its recommendation on Restaurant Brands, the owner of Burger King and Popeyes, saying the stock's recent slump overdone. Gregory Francfort joining us right now, director and lead restaurant analyst at Guggenheim Securities. So, Gregory, give us kind of the bull case, a potential bull case for this stock going forward.
Yeah, thanks for having me on. One of the things that we've seen in the restaurant space, and particularly quick service over the last couple months, has been a really big slowdown in the stock prices. I mean, you've seen big drops. Restaurant Brands International over the last 12 months is down almost 20% versus an S&P 500 that's up 25%. And so this is reflecting a little bit more of a challenging quick service backdrop. However, we think at this point it's overdone. This is a company that is growing units 3.5–4% globally. It's growing EBIT mid to high single digits, and it's trading for a sub 16 times PE that we think is just excessively low at this point, given the share price underperformance.
I mean, what was interesting, though, Gregory, I mean, when we talk about why the stock was down and we talk about some of the comps, particularly that we saw in more in 2023, and I know they started to rebound a little bit in 2024 with some of the growth numbers, both on the revenue side and margin side. You're confident that that can continue into 2025?
Yeah, I think one of the things that we're looking for is for an improvement in the international businesses, particularly after some of the challenging global pushback to American brands to end 2023. You've seen 4 quarters of a little bit more stagnant international comps. Restaurant Brands International in the third quarter comped about 2% positively. We think that can accelerate up to 3 to 4%, and maybe even a little bit faster as we get into the fourth quarter. We've already seen Papa John's pre-announce 5-point better numbers from 3Q to 4Q in their international business. We've seen some international franchisees accelerate a couple hundred basis points. We think there's some optimism maybe outside the U.S. From what has been a challenging last 12 months.
Hey, Greg, what does their profile look in terms of margins? Like, how much does it cost to run this kind of business right now?
So because it's a very franchise business, a lot of the cost structure has been in G&A. And one of the things we've seen from Yum, we've seen from McDonald's, we've seen from RBI, is we've seen a very aggressive focus on cost controls as you've seen a little bit of a slower top line environment. And so, look, the stock's down for a reason. You are seeing some pressure on the pace of development globally. It used to be kind of 4 to 5%. Now that's going to slow down to 3.5 to 4%. Street numbers have come down about 3% for 2025 over the last 12 months, and we're 3% further below that. However, the stock's down almost 20%, and the valuation's hitting levels where it's expecting. We think the market's expecting this company not to grow, and we expect it to grow.
Fair enough. So it's discounting way too much at the end of the day. Greg, talk to me a little bit about the demand side and how it corresponds to, say, the macro environment.
Yeah, so the macro environment, Darden is probably the bellwether for the consumer in the restaurant space, and they talked about a little bit of an improvement in the 50 to 100K income household when they reported earnings about a month ago. We've seen a bit of a challenging sales backdrop the last 1 to 2 months in restaurants. It's been a very cold January. I'm in New York. I am wearing about 3 more layers than I normally do.
We feel you, Greg.
So I'm feeling it. And but we're expecting things to be a little bit soft and maybe rebound as we get into February and March. One of the things that has happened in the quick service space is McDonald's has launched a new value platform that happened January 7th. We think the results of that have been okay. But maybe not as bad as feared for some of the competitors, which would include Burger King US for Restaurant Brands International.
Oh, interesting. All right. Hey, Greg, thanks a lot. We appreciate that. We also are in New York, so we also are layered all the way. So Greg Francfort of Guggenheim Securities, thank you very much. Are you a McDonald's or Burger King guy?
Neither, really.
Well, yeah.
But
If you had to pick?
So if I had to pick, probably Burger King, right?
Same.
The flame broiled stuff, when I was younger, that was always appealed to me about more. So.
I feel you on this. We feel each other on this one. All right, coming up, natural gas company Venture Global is officially trading now on the NYSE. We're going to talk to the founder and CEO next. This is The Close on Bloomberg.
The intersection of private and public, that's come of age. So maybe you don't go public in the classic NASDAQ, New York IPO at the first. Maybe you do some hybrid capital for a while, and then you go public a la Uber. But we've been below trend line in the M&A market. We talk a couple years from now, I think we'll be a trend line or higher. I'm pretty confident about that.
You think it's going to be M&A? You think it's going to be IPOs?
I think it'll be
everything.
Ted Pick, of course, over at Morgan Stanley, out there at Davos, talking about an opening up of capital markets, 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
I'm Alex Steele, and we're kicking it off really pretty strong over the last few weeks, right? We've heard a lot of IPOs are starting to come out. We've heard everyone and their mom are talking about M&A and how we're going to see a huge move in M&A.
We heard from Adina Freeman earlier at Davos. We heard from Lynn Martin over at Davos, and they're all pretty much singing from the same hymnal. We're going to see a much stronger capital markets in 2025 than we saw last year.
And speaking of IPOs, we had a big one today. Venture Global, LNG exporter, went public today on the New York Stock Exchange at $25 a share, raising about $1.75 billion. It's the largest energy company IPO since 2021. Now, the stock is trading down from that price about 3.5%. Now, just what makes Venture Global unique is its use of modular liquefaction trains. What that means is it shortens project development time by half. Now, here in the studio with more on this and the IPO is Mike Sabel, CEO, Executive Co-Chairman, and founder of Venture Global. First off, Mike, I got to give you a victory lap. This was a hard-fought battle. I've known you for a very long time. Congratulations on getting it out the door.
No, thank you very much. It's exciting. I'm excited for the whole team and everyone's families that have supported us for 15 years.
Yeah, no, it's been a while.
Yeah.
I got to ask you about the price action, though. So you guys downsized the IPO by about 40%, and now you're trading below that price, that $25 IPO price. What do you make of that? Like, are investors talking to you about being nervous about something? Like, what's your take?
With the green shoe, we'll raise the $2 billion, which was our target. And we're incredibly pleased with the execution and the outcome of the transaction. We're building assets for the next 100 years, our factories that manufacture liquefied natural gas. And so we're extremely pleased.
You guys are different. Like, you do it differently. That comes with risk. It comes with opportunity. It comes with costs, like arbitration with some of your customers, et cetera. Do you get a sense that investors felt you were too risky, or do they need more proof of concept?
No, I mean, we achieved a great valuation. We're certainly a high growth business, and we take a very different approach from the incumbents. And our earnings trajectory is, we believe, very steep and going to be very attractive for investors. And so as we continue to turn on our liquefaction trains faster than anybody's ever done before, we just turned on Plaquemines, our second LNG facility on the Mississippi River last month. And as of this morning, we're producing from 11 trains. We're running way ahead of schedule. And our ramp up of earnings from those facilities is much better than we expected.
And give us a sense of how quickly a new one can come online relative to what we've had in the past.
Sure. I would say the average in the world for new facilities is first production coming 6 to 8 years, trending maybe more towards 8 years than 6 years. Our first two facilities we brought online in 2.5 years. And that's an enormous change in the return on capital and velocity of capital. Because when you have a $20 billion facility and you don't make any return for 8 years, you have an enormous earnings hole you have to dig out of, which causes you to leverage the facility and pay it off over 20 years. In our case, we start producing in 2.5 years. We largely pay them off during construction, which then allows you to enjoy earnings from your facilities for 50 or 60 years. And the way we like to describe it is if you picture building a commercial office tower, as we're building from the ground up, we're leasing the floors as we go because we have more liquefaction trains in our facilities, 36 versus 3 big ones. And by the time we're finished building to the top floor, we've paid off the whole facility.
So just explain this to me, and Alex Steele was trying to explain this to me earlier. So with that concept, I like the analogy, and I mean, I'm not the expert on this, but I like the analogy. So you're collecting revenue off of the first few floors, so to speak,
during construction
as you go up here. Is there liability associated with that, the fact that the top floors are still to come?
It's a great question. You have to be very, very careful as you do it. We have arguably one of the best safety records in the world for large construction projects. We're 10 times better than the average. And you have to do it with the support of the regulators in state, federal, and local. And we've worked with them for years, and it's taken us 10 years to figure out how to execute it this way.
So we'll get to customers in just a sec. But let's just talk about the demand profile. President Trump has talked a lot about the importance of energy, especially when it comes to ending the war in Ukraine. Have you talked to President Trump, maybe the Department of State, Department of Defense, or anything like that yet?
We've been, well, we do continuously. We're heavily regulated. So in multiple administrations, we've been doing that for years. We are very eager for the new team to be in position, and we've been starting to talk to them.
But in relation to like helping end the Ukraine war,
they're hugely supportive. No, we think we're going into, and this is significant, maybe the best permitting environment in decades for energy, including natural gas, pipelines, E&P, and our allies around the world are very eager for the supply.
So then let's talk about the allies and the customers. So obviously you're still in arbitration with a couple of your customers. And the idea is you have smaller module facilities that you turn on in sequence, but you have to make sure everything's up and running and that no bolts are broken and that no doors are broken before you can actually hand over that supply to your customers. In the meantime, you're selling that natural gas because you want to see how it works. You want to make sure nothing's broken.
That's right.
Arbitration, though, was pretty brutal. The comments from your customers. Are you having any difficulty signing more customers because of that?
No, absolutely not. We've signed those identical contracts with the same execution plan, the same deployment of our technology. for subsequent facilities like our next one, CP2, with great companies like Exxon and Chevron and the government of Germany, same contracts. It really is pretty straightforward. We're not finished with our facility yet. We're almost done. Our primary regulator, FERC, says we're not done. Our banks, which include J.P. Morgan and Goldman and Morgan Stanley and BAML and others, say we're not done through the independent engineer that works for them. And we're shortly going to be done. And when we are, we're going to be the second or third fastest facility ever done. The difference is we start producing earlier in construction, not later.
I just have to ask you, though, about competition. And, of course, anytime you're a pioneer in a space, it's only a matter of time before, the imitators start to come in. But there are some pretty formidable potential imitators out there. And I do wonder how you sort of, if you need to guard against that or if you're worried about that.
We worry about everything every day. Look at where we are today. We are finishing up our first project. We've turned on our second one, twice the size. Our third one, we're $4 billion into it, and we're taking delivery of our 55th and 56th liquefaction train next quarter, end of next quarter. And our next one, we call CP3 creatively, is about a year away from beginning to fabricate. With just our first three projects, in the next few years, we'll be the largest producer in the United States and beginning to catch up and pass Qatar as the world's largest.
You are definitely a disruptor. Many were very skeptical of you guys for a very long time. And I feel like you're trying to take that disruption now to the tanker industry and to the regasification landscape and basically become this like vertically integrated LNG exporter with ability to export, move it, and then regasify it for your customer. Can you just walk me through like what you think your company is going to look like in 5 years?
Yeah, we're vertically integrating more to enhance and improve the return profile of our facilities and our company. As we're producing faster, we're aggregating larger and larger amounts of LNG production in the future. And so we wanted to be able to have a shipping fleet and regas capacity that will allow us to service end customers directly and not have to trade it with trading companies in the middle, which are a great part of our business, but we wanted to have that flexibility.
All right. Well, Mike, first of all, congratulations.
Thank you very much.
You had a chance to ring the opening bell today. I know that must have been an experience as well. And of course,
with my kids as well, which is special. Thank you.
Did it make you cool?
No.
Yeah, I didn't think so. In their eyes.
No, it did not. Yes, you have kids, you understand.
Well, 20 years from now, they'll be like, oh, look how cool Dad was back there in 2025. Mike Sabel, CEO of Venture Global, the newest kid on the block in the public markets. When we come back, we're going to talk about one of the old kids on the block, and that is Apple, a sour day for that stock. Heading into a very consequential earnings report next week. It's our stock of the hour, and it's up next right here on The Close on Bloomberg. Let's talk about Apple and its AI ambitions struggling to bear fruit. In fact, the shares, we should point out, they have not had a weekly gain since December. In fact, the stock right now having its worst start to the year since 2008. And we learned earlier today that they're going to make some big changes in the AI space, moving veteran software executive Kim Borath to their AI machine learning division to maybe help improve things there. Jess Minton joining us right now to maybe improve our perspective here on what's going on with stock. I was a little surprised by this. I kind of forgot they're in correction territory. The stock really hasn't done anything of significance in over a month. This isn't about smartphone sales, is it?
No, it's not. So this is actually its max drawdown from that high we would have seen less than a month ago. So it was in late December. It's down more than 14% since then. So to your point, in a correction. But it's interesting because what we're talking about now, if you think back a year ago in the first quarter, how Apple performed relative to the S&P 500, that was its worst performance in over a decade at that point. And then it turned things around going into the second quarter. Just from a technical perspective, that's when it bottomed in mid-April and then took off from there. And obviously last May was when it announced that historic buyback program. So now we're kind of in a similar position where since then, obviously it had the Vision Pro, but it did not perform as well as it was expecting. And of course, the iPhone is still the powerhouse if you think of how much it makes annually, more than $200 billion, more than half of its revenue. Right.
What's that again?
So
the goggle thing?
Exactly. So the big thing now kind of moving forward when you're thinking about its earnings release after the bell next Thursday is what it's going to say in relation to AI, because there's an M chip that it has. It's an M4 chip that's supposed to be more about the processors related to AI, what that means. It revealed some details last year, but it's supposed to be when it comes into more types of products, whether some of its computers and beyond that, what is it going to do? Because it's hard to have another generator compared to what you've done, especially when you look at the iPhone for over a decade.
Yeah. I mean, we were talking about this earlier, too, like what's going to be the thing in Apple's earnings, right? Like, can we move it forward to AI, to something cool, more interesting? And I'm like, I think it's just straight up iPhone sales again. Like, they still can't move that needle.
Something that Mark Gurman, obviously his beat covering very closely what Apple does. From a technical perspective, though, it was trading at 260 at the end of last year when it hit that record. Now it's just above 220, and that 200-day moving average is at 218. So right now, kind of from a technical perspective, if you do the 50% retracement from that April low of last year to its high, that would put it around 212 is what technicians are looking at, and potentially you could see it break that 200-day moving average.
Isn't it? But that could potentially be bullish. I mean, there are a lot of people who, of course, look at that 200-day moving average as a buying opportunity.
And people stack money against those levels, and so that's something that's key to watch to see if it bounces from here. Something else from technical is just like a MACD level, because the momentum keeps moving down further.
Now, the question is, though, how much will it bounce? I mean, if there's no momentum on the AI and the smartphone sales and all these reports coming out of China that they've moved on to other devices. I don't know. I have an Apple iPhone. I don't really use the AI stuff that much. I don't know if you...
Neither do I.
I have absolutely no idea how to use it. Like, it would probably hit me in the face and I would have no idea. I mean, I know that surprises everyone. All right, Jess, thanks a lot. Really appreciate it. Bloomberg's Jess Menton joining us there. We're 15 minutes to the close of trading. Best weeks for the beginning of a presidential cycle since 1985. This is Bloomberg.
We find it a pretty compelling environment for investors to sort of take a reset and understanding that, yes, there's some uncertainty, but there's still some great opportunities out there, and we should take and survey the landscape for what the fixed income environment and specifically the rates market has given us over the past 6 months in terms of higher yields.
Jerome Schneider over at Pimco kicking us off to the close about 50 minutes ago, a conversation about rates. Rates, we should point out, relatively unchanged on the week, though that, of course, could change next week with the Fed on tap. As far as stocks, Alex Steele, I know you're keeping count of our record highs.
Just the one, man. Just the one. It could have been exciting, but we're really fading here into the close of trading on this week. Clearly, the last few weeks, though, have been really good, the last 2 weeks in particular. But the S&P is now down by about 4%, 0.4%, I should say. But it does feel like it's all a chip story, right? I mean, it is a Texas Instruments story from earnings that leads on the SOX index, et cetera.
And the thing I've been trying to figure out all day long is why the weakness. Is this about some of the valuations that we've seen in some of those chip stocks and other things, and maybe that's coming up, or people kind of spooked by what we heard out of SK Hynix and Texas Instruments, and is that maybe the driver of this, and Apple for that matter? Is that sort of driving this?
Like actually something fundamental?
Fundamental.
I mean, it could be, particularly headed into earnings. And interestingly enough, when we keep on talking to some analysts, they're like, look, it's not really about the Fed anymore. It's going to be about earnings. So from that case, if you don't deliver and the outlook is a little bit dicey, well, then there you go. Well,
more about 100 S&P companies scheduled to report earnings next week. That includes names like Apple, names like Meta, and quite a few others. To break it all down for us, let's bring Kara Murphy into the conversation. She's Chief Investment Officer at Kestra Investment Management. And Kara, I do want to talk fundamentals with you because I know there's been a lot of talk about the rally and margin, multiple expansion and all that, but there was a real fundamental driver to some of the gains that we saw last year. And I'm wondering whether those fundamental drivers, in your view, are still relatively intact.
So I think that's the big question for 2025. And the Mag 7, like let's take them. If you sort of track the market cap of the Mag 7 as a percentage of overall S&P 500, and then look at their earnings power and earnings contribution overall to S&P 500, it's been really strong. But it has started to diverge, and that's valuation. So valuations have started to increase at a faster pace than earnings have. And then when you look forward to the end of 2025, what you have is Mag 7 earnings that are starting to slow. They're still great, but they're not going to be quite as great as they were. And in the meantime, everybody else in the S&P is going to start to see their earnings begin to catch up. So the question is, by the time we roll forward to the end of 2025, as the earnings differential narrows, does it make sense to have such a large valuation differential? So it doesn't mean that the Mag 7 earnings are bad. They're just not as good on a relative basis compared to everybody else.
But that gets to the whole question, Kara, of why can't we sort of put our faith in everything else? Because that was the story last year. Oh, it was just the Mag 7. All the other 493 stocks in the S&P aren't doing anything. And now it looks like, well, maybe potentially a good chunk of those 493 might actually finally step up to the plate. I know they don't have the same weightings as the Mag 7, so they may not move the broader market. But at least if you're an individual stock picker or even a sector picker, then it seems like there is opportunity.
I mean, just think about it. 493-ish names out there that have lagged the other 7, or at least in aggregate. So there are a lot of great places to really choose from. And as you said, in aggregate, they've seen much less healthy earnings. But going forward, it feels like the overall economic cycle is going to be a tailwind for them. Previously, the Mag 7 have really ridden that tailwind of AI, which was very specific to those names. But when you look at the broader kind of economic underpinning, that's going to impact a wider swath of companies, that still looks fairly favorable. And you still have pretty strong earnings growth. You still have inflation that's subsiding. All of these things are really good for the rest of the economy and therefore the rest of the market.
So, Kara, I wonder, though, is it the kind of thing where the S&P is just not going to go anywhere fast? Maybe the equal weighted or the Russell or mid caps or individual sectors within the S&P are just going to do better?
Yeah, and so when we look at kind of the different options that investors have within the stock universe, we think equal weighted S&P or even down into mid caps is a really attractive place to be. I mean, if you compare the mid-cap index relative to the Russell 1, it's running at about 20% of the overall market cap. That's the lowest that we've seen since the 1960s. So what that tells you is just expectations for those areas are incredibly low. Valuations are also more attractive. And as I said, within the mid-cap world, you start to see that pickup in earnings in the second half of the year. And I think ultimately, this is going to be about earnings driving these names.
Right. We were just talking about that. Like, it's maybe not the Fed. It's actually going to be earnings. It's going to be that bottoms up and that actual earnings growth. Are there certain sectors that you think could be those outperformers?
So luckily in the mid-cap world, it's actually much more diversified than what we see in the S&P 500. S&P still remains very, very dominated by technology. The technology weight in the mid-cap space is about half of what we see in the S&P 500. So the good news is that you don't have these huge valuation differentials by sector like you do in the large cap universe. So there are a lot of different opportunities. You can even go for technology if you really believe in that kind of secular story, and still find a lot of names that are not overly expensive and that we'll see some earnings bumps by the later half of this year.
I have to ask you just a quick question here, Kara, about what's been going on in the fixed income space, with is quite frankly a lot of nothing. That could change, though. We are going to get that Fed meeting, or that Fed decision, on Wednesday. So maybe we get some insight into the Fed's thinking about where inflation is. And I guess for investors, we'll get maybe a better sense of whether that's going to impact valuations in the market.
I think the next meeting will be really telling because, of course, it's also the first one under this new administration. And as we know, Trump is being a little bit more aggressive and trying to influence policy than many of his predecessors have been. So how this dance plays out will be really important. But another thing I would highlight is that heading into 2024, there were very, very aggressive assumptions about how quickly the Fed would start to cut interest rates. And so compare that expectation and then where things actually ended up, right? So the Fed cut much, much less than markets had been hoping. Now compare that to the beginning of this year, where markets expecting one-ish cut this year. That's a much better place to be in terms of the Fed being able to outperform expectations. So as long as inflation kind of holds in check, we could actually see more Fed rate cuts than what the market is currently expecting, which would be bullish for the markets.
Kara, always a pleasure. Kara Murphy, Chief Investment Officer at Kestra Investment Management, helping us count you down to these closing bells. Those bells now just about 3 minutes away here. We talk about debt market right now that's basically gone nowhere, but stocks actually went somewhere. It's not a great day, but it's actually a relatively good week. Second straight week of gains for the S&P, second straight weeks of gains for the MSCI All World Index as well.
And I should point out, Apple's 200-day moving average so far is holding. We're about 4 or 5 points above that level. I'm super interested, though, to see if we break below that. Does it drag other indices parts down with it? Or was it just really an Apple-specific iPhone story?
And maybe it's an Apple-specific story, but you also talk about leadership in this market. I think it's kind of maybe a testament to that NVIDIA and chip stocks really have become kind of the dominant mover. I know they're not doing much today, but that's where investors are putting their chips.
Ooh, nice one. I saw what you did there, which makes next week all the more important with the big earnings.
We are moving closer to the closing bells here on this Friday afternoon. A full breakdown of the market action today and on the week starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through that closing bell. A global simulcast starts right now. Scarlett Fu in the TV studio, Carol Masser and Tim Stenovic in the radio booth as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A down day, an up week. Carol, make sense of it for me.
Yeah, I don't know how to make sense of it. It's so funny. We just had a market guest on saying, there's so many questions out there about what we're going to get from the administration, tariffs, trade, tax policy, and yet you've got a VIX that is just below 15. And he just said, with all these questions out there, he thinks that volatility and concerns about the market should be a little bit higher.
Well, we did get one answer with relation to cryptocurrency yesterday in the White House just before the market closed. We saw the crypto czar in there, David Sachs, along with President Trump, signing an executive order related to crypto. We didn't see Bitcoin move yesterday, but it's moving today up 2%, 105,000 for Bitcoin.
Yeah, but that's not a move for Bitcoin at all. That might as well be unchanged.
Shade there.
It's so hard to attribute Bitcoin's move in any direction to any single thing.
Yeah, absolutely. I mean, there are a lot of known unknowns in this market right now, and I feel like maybe at the end of a very busy week, people are just breathing a sigh of relief that it's kind of come to a close, and we're going to gather up our strength to get ready for next couple of weeks and months of a lot of headlines.
I like when Scarlett comes in hot. I'm just going to put it out there.
It's because they wheel her in.
I know.
Now,
right?
a lot of funds also, though, you can make an argument like CTAs and vol-controlled funds are going to have to buy soon, particularly if volatility stays low, and you wonder if we're going to see that as the next leg higher for equities.
We get the closing bells here in New York. It is red across the screen on the day, but we should point out stocks still holding 2 straight weeks of gains right now. The S&P 500 is going to settle right around that 6,100 level. That's down about 17 or 18 points from where it was yesterday, a drop of about 0.3%. A similar percentage drop for the Dow Jones Industrial Average. The NASDAQ Composite down about 0.5 percentage point. The NASDAQ 100 down 0.6 percentage point, while the Russell 2000 is going to close out the day lower by about 7 points or 0.3%.
All right, quick check on the S&P 500 in terms of winners and losers. You've got Scarlett, 249 names to the upside, 248 to the downside, so almost an even split there.
Yeah, and a pretty even split, too, when you look at the sector performances. 2 groups finishing up by more than 1%, communication services, as well as utilities, and also 2 groups finishing down more than 1%, and that would be tech and energy.
All right, guys, let's get to some of the winners and losers, gainers on this Friday. Novo Nordisk is one of them, up about 11% at its highs today, finishing the day with a gain of about 8.5%, rallying the most since August of 2023. They did put out some news about their experimental shot that delivered as much as 22% weight loss in early stage trials, boosting investors' hopes for the drug maker's pipeline. There's been a lot of worries. This stock has been under the ADRs, and also the stock overseas has been under a lot of pressure over concerns about kind of what's next for GLP-1 drugs and the pipeline. The results basically putting this drug maker back into the contested race about who can deliver the most from all of these weight loss drugs. So definitely a standout in today's session. Meta also a little bit of outperformance there, up about 1.7%. Mark Zuckerberg on Facebook putting out a post saying that Meta plans to invest as much as $65 billion on projects related to artificial intelligence this year alone. That's more than what they were expected. And that includes building a giant new data center, increasing hiring in AI teams. So that we saw some outperformance there. And Paramount Global, I thought this was a done deal, but apparently not. This one as high as 3.7% earlier in the trade, finishing the day up 1.9% here. This, as Variety reported, Project Rise partners to make a bid for Paramount, offering up $19 a share, all cash. That's a competing bid to Skydance Partners, which has offered up $15 a share. So once again, it seems like maybe possibly in play here, but definitely a gainer in today's session.
If this story were like a series on a streaming service, it would be like in its 8th season at this point. The story is just not ending. Hey, I want to look at shares of Boeing today, down by about 1.4%. They did that surprise announcement late yesterday, reporting preliminary fourth quarter revenue that missed consensus estimates. The company did say that last year's strike affected the results. It noted charges for certain defense, space, and security programs, as well as costs related to previously announced job cuts. I will say Julie Johnson and the team, our aerospace team, they've got a great big takeout about Boeing, and Elon Musk challenging Boeing just last month in person with Kelly Ortberg. So go check that one out on the Bloomberg terminal. Intuitive Surgical falling today by just about 4%. They make the Da Vinci surgical robot. The company did come out with a profit margin forecast for the year that trailed expectations. It also warned about potential impact of new tariffs. Could actually be material. Shares falling today by 4%. And this is an IPO, and yes, it's in Alex Steele's world, a natural gas exporter that went public today. Venture Global falling 4%, even after slashing its price target ahead of its IPO. Shares fell. The IPO price was $25 a share. This is not a great look. They sold 70 million shares in the middle of a reduced range to raise $1.75 billion. The market cap is about $60 billion at this point, roughly $58 billion. It was looking for a market cap of $110 billion before it scaled back its offering this week.
Yeah, we already talked to the CEO, Tim. Like, you're way late on that. I mean,
wow, you guys are
shade.
So what did the CEO say about this?
So I asked in a couple different ways in terms of the reduced price, in terms of the pop. And, you know, on your IPO day, you're going to say you're really excited about your IPO day and you're really happy that you raised $2 billion and that you're going to use it and make more money.
So he's very consistent in his responses.
Yes, so there is that. But I'm interested to see how it continues to trade, who winds up actually owning it, hedge funds or institutional investors, if they're energy people or not. I can go on and on. Instead, I'll go to the bond market.
But don't get mad that I'm not watching your show well.
I am, because the screen's right in front of you.
Okay.
Oh, and I know this because I watch TV when I'm on radio. Anyway, let's go to the bond market.
Wow.
Going to the bond market.
Is it the bond market calling?
Right.
I think the bond market's calling.
Bond market's calling. You guys are lower. That's pretty much it. But I did want to highlight a lot of supply coming on Monday. You got the 5-year and the 2-year. You're looking at $140 billion of supply coming on Monday, and you got the 7-year on Tuesday. That's kind of ahead of that Fed meeting on Wednesday. So let's definitely watch those.
Guys, I don't know what you guys are doing this weekend, but I think it's time to go to Washington.
We're rewatching Alex's show. We're rewatching Alex's show. That's what we're doing this weekend.
But you can go to Washington, D.C., and you can see the pandas. They're there. Bali and Qingbao are the new pandas in Washington, D.C. They've come back. And the Panda Cam, if you want to stay in and watch Alex's show, can also have the Panda Cam.
Okay, first of all, it's not my show. It's our show, you guys. It's our show. Panda Cam, I had it up all day today. What about you guys?
Did you see them do anything?
Well,
yes,
again,
they ate, they rolled, they walked.
Our work. Again, we were doing work today.
You know, years ago, I took my daughter there. Like, we did a trip because she was so into pandas. And I got to say, it was pretty cool to see them in D.C. That was before they were yanked out and brought back.
They're just really cute. They're all over my Instagram feed. They're like little kids, and they're really wobbly. And
they're a little ferocious, though, you know.
Bumbly.
They're a little ferocious.
That too.
You don't want to fall into the pen.
I mean, are you a Panda Cam lover?
These are ferocious?
Yeah.
Oh,
they're
they
so
can
cute,
be.
though.
Yeah.
How do we know this? Is there evidence of this? I've never seen a panda attack anyone.
That's probably
Google
good.
pandas going wild or something.
I'll pass on
I
that.
really don't
reality
show.
show.
I don't know what that's going to do. You trying to get us
All
fired?
right. Well, having said that, all right. So they're loved in D.C. They're also loved in China. We know that as well. But apparently, the fan culture in China is getting, I don't know. The government's getting kind of a little tough on them. They've sent a chilling message. This is coming from the New York Times to panda fans to watch what they say online. Specifically, some online influencers have been arrested or questioned over what the authorities called rumors and radical fan culture when it comes to pandas.
Yeah, it's a little wild. The police, according to the New York Times, have targeted people who've advocated for animal welfare, or they've criticized these overseas exchange programs, like the one we're talking about in Washington. State media, though, has also published warnings about broader panda fandom. The New York Times notes that the move comes amid Chinese leader Xi Jinping's crackdown when it comes to internet fan culture.
They've arrested people for spreading false information about pandas. Like, what do you spread?
That they rip people's faces off if they don't?
No, I think there was some criticism about how maybe some places were really aggressive with making sure that the pandas definitely propagated, and they weren't being super considerate when it comes to making sure the pandas were taken care of, as opposed to like making sure that there's enough pandas available.
Yeah, some animal welfare. Okay. Bum, bum, bum. Okay, that was a down note.
Go see pandas.
All right.
Panda
pandas. Panda Cam. Everybody. All right, that's a wrap. Have a safe weekend. Stay warm, everybody. That's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We'll see you again, same time, same place on Monday.
All right, our coverage continues here on Bloomberg Television. We're going to set you up for a big week in earnings. Apple, Microsoft, Meta, Tesla, all set to report next week. A conversation up ahead with Angelo Zino over at CFRA. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A record week for stocks, though today it doesn't necessarily feel like it. The S&P did hit a record high earlier in the week, and in fact, it closed out the week with its second straight weeks of gains. That's despite the fact that you're seeing the red on your screen, a bit of a downdraft in some of those tech stocks, particularly in the chip space. A conversation on that in just a second. I do want to talk about the 10-year yield here. It's basically pinned exactly where it was about a week ago. That could change next week once we start to get earnings, when we start to get some of the monetary policy decisions, including out of the ECB and the Fed. And if you're looking for a bright spot today, you're actually going to find it in Bitcoin. Right now at the 105 level, was trading above 106. But Scarlett, I think we got to talk about what we saw today in the tech space.
Yeah, and let's start with earnings here, because you mentioned we did see some gainers. Verizon is one of the gainers in the Dow Industrials, up by 0.9%, helping to lead the communications sectors up. We saw that fourth quarter results beat analyst estimates on gains in new mobile phone and broadband customers. On the flip side, Texas Instruments, you mentioned chip makers, that stock down 7.5%, the worst performer in the Philadelphia Semiconductor Index, gave a disappointing earnings forecast on sluggish demand from industrial customers, which could be a sign that we have not yet seen the bottom yet in that clearing of excess inventory. So it's something we'll keep an eye on when it comes to those chip makers. Romaine?
Before we move on, just some breaking news here. This on Starbucks, this on the new CEO, Brian Niccol, this on his compensation package. $95.8 million. That's the 2024 total comp. We actually had some of these numbers before, of course, when he got hired, but now we're getting that confirmation there. Meanwhile, we do want to go back to what it really did move the market this week, and let's bring in Cain of Bloomberg Intelligence for our Factor Friday. And we're going to start off here with the U.S. equity factor. How did it perform this week?
Oh, well, equities did well this week, but I mean, so let's look at what factors have done, right? So just to put it in perspective, 2024 was a very good year for factors. So of our four main factor families, right, value, momentum, low volatility, profitability, three of those four were up in 2024, up by double digits. Value was the only one, but down just slightly. So far in 2025, momentum just continues the momentum. I mean, it's performing very well. High momentum stocks to beat low momentum stocks by about 5% so far in 2025. Momentum was the best performing factor in 2024. Value and profitability really haven't done too much. It's low volatility that has suffered so far this year. High vol beating low vol by about 5%. So it's low vol moving, momentum moving. The rest of them have kind of stayed flat for the year.
Well, speaking of volatility, the VIX is now below 15. You did some work on the VIX and levels and future value factor performances. What did you find?
So this is pretty interesting, Scarlett. I think it's interesting. So, we looked at VIX levels and future factor performance. So during VIX spikes, so during vol events, it's very well known what works, and it's very logical. Things like low volatility, high profitability, things where you could hide out, right? But predicting these volatility events are pretty hard. We wanted to see after the volatility event or the volatility spike happened, then what happened. In the forward 3 months after the highest 20% of VIX levels, the best performing factor is actually value. And it performs very, very well. I won't bore you with the numbers. I think what's happening here is that VIX typically mean reverts. It goes higher, right, and then it rolls over and goes lower. When it rolls over and goes lower and, the kind of coast is clear, a lot of investors then move into very, risky parts of the market like value stocks. And that's what really, helps the value factor return so well after high VIX levels.
So I would have thought, and obviously you're much smarter than me on this, I would have thought low volatility would have been the play in that.
So that's the thing, Romaine. During the VIX spike, it's low volatility. During the VIX spike, it's high profitability. The problem is predicting those VIX spikes are pretty hard. But just observing that the VIX spike happened, right? That's not as hard, right? So what we wanted to see is kind of like an actionable signal. You see the VIX spike, you see it's historically a high level. Over the forward 3 months, it's those recovery factors like value and even high volatility that tend to work.
All right, Chris Cain, really appreciate your joining us as always. Chris Cain of Bloomberg Intelligence with our Factor Friday. We're going to turn now to tech because companies are clearly going all in on AI ahead of big tech results due out next week. Meta, for instance, is planning to invest up to $65 billion on AI in 2025. Meanwhile, you've got Apple enlisting veteran software executive Kim Vorath to help fix its AI efforts. So let's bring this all together now and bring in Angelo Zino, who's a technology equity analyst over at CFRA. Angelo, with the Meta upgrade in its CapEx spending on AI, you would think that would provide a tailwind to this sector because people are kind of rewriting how much they think will be spent this year, but it didn't do much to boost the market. Why do you think that is?
Yeah, I mean, listen, I think that's a good question. And, specifically when you kind of think of some of these chip names out there, I mean, and they definitely underperformed here during the day. I don't necessarily know, exactly why that's the case. Yeah, I can kind of come up with, certain reasons. I mean, one, we did have Texas Instruments report, obviously, last night, and I think that kind of painted a negative cloud, across kind of, the broader semi as well as tech space today. I think you also have a situation that at some point in time in these cycles where too much of a good thing ends up being, somewhat of a worrisome issue for a lot of people on the buy side because, the comps get a lot more difficult. And it's not necessarily about what 2025 looks like, right? It's about what 2026 and beyond looks like for names like an NVIDIA right now. And when you kind of start thinking about kind of the pull-in effect on some of these CapEx numbers, whether it have Microsoft with the $80 billion number or whether it be a name like Meta now at 60 to 65 billion. And that implies a capital intensity rate of about 34% when you kind of look at the projected revenue levels here in 2025, probably a level that they can't sustain for a prolonged period of time. So that likely means that they're going to slow down some of that CapEx spend in future years. So I think some of that pull-in effect might be kind of worrying some investors out there.
Okay, yeah. Meta chose to disclose this today as opposed to during its earnings call. What do you think that signals? Do you think we're going to get more concrete evidence that it is seeing a return or it is able to monetize all that investment so far?
Yeah, I mean, I think a couple of reasons why they did. First off, I think it was great that they did it ahead of the call because it could have, painted a kind of a negative sentiment, given that they know, what, the street is looking at this point in time, and that 60 to 65 billion, definitely well above kind of our outlook of a little bit north of 50 billion. So I think it's good to kind of get that out of the way. I think now all eyes are going to be, well, what are you going to do with that 60 to 65 billion? And if that is a level that's probably going to be sustained here for a couple of years, what exactly are we looking at here in terms of AI monetization? So we expect them to kind of, talk at length about some of those investments out there. Clearly Llama 4 is going to ramp here in the first half of the year. So we kind of want to see where they are on that side of things, how things look, in terms of kind of the Meta AI kind of opportunity and how they look to monetize that. Do we start seeing that in 2025 or is it more in future years? They have kind of alluded to the fact that, hey, listen, some of these investments that we're going to do today isn't going to come to fruition for a couple of years now. So if you're an investor out there, I wouldn't kind of hang too much kind of hope in the sense that you're going to see significant AI monetization in 2025. But the expectations here is kind of the digital ad spend space remains very kind of healthy in nature off of much more difficult comps.
Right.
And we are looking for kind of mid-single digit, mid-teens growth here in 2025 for Meta.
Well, I mean, when we talk about that AI spend, though, Angelo, and this kind of segues into Microsoft, I mean, we are expected to see a bit of a deceleration in growth in Azure, still 30%, I think, is what most analysts have modeled. But also, we are also expected to see maybe a little bit of depreciation from that AI spend. So kind of square that circle as to what investors should expect when Microsoft reports.
Yeah, and I think Microsoft is a little bit different than Meta, right? Because with Microsoft, they've got that cloud business where you can actually kind of get you can get actually more AI monetization kind of here immediately, whereas a lot of Meta's investments are kind of investments that they're making into a number of businesses here in the future. Now, as far as Microsoft is concerned, yeah, I mean, the December quarter probably represents about the third consecutive quarter of deceleration on the cloud side of things. And a big reason, Microsoft was actually kind of the biggest loser, we think, in the second half of last year among the Mag 7 names, is a combination of kind of the higher CapEx spend, higher than expected CapEx spend, plus that deceleration on the AI side of things, partly because of the Blackwell delay as well. Blackwell ramps here in the first half of the year for Microsoft. We actually think that cloud revenue will actually start to accelerate here in the initial months of calendar 2025, which is why we actually like the Microsoft setup going into 2025. You're absolutely right in terms of kind of the higher depreciation expense out there. They have kind of guided towards that for a lot of investors out there. It's going to result in some kind of operating margin compression. We're looking for about 100 basis points here in the calendar year 25. So a lot of that is kind of baked into some of the numbers out there. But whether it be a Microsoft or a Meta, you are going to kind of see some margin compression in 2025 versus 2024 levels.
This has raised a lot of questions too, Angelo, kind of about what AI is in terms of what it means to the bottom line. I could kind of make sense of it for a Meta. I could even make sense of it certainly for a Microsoft. I do want to pivot, though, to Apple, because this has been a big topic of conversation. I know they call it Apple Intelligence or whatever they want to call it. Last time I checked, it ain't really catching on. And I know they made a big executive change today, moving a much more experienced veteran to kind of aid in the development, or the improvement, I should say, of some of those AI efforts. When we talk about kind of the consumer-facing part of AI and the adoption of it, does Apple actually have the chops to really make this work?
I think it remains to be seen right now. I mean, clearly, Apple Intelligence hasn't, rolled out on a global basis, right? And I think that is kind of a big problem right now for Apple as well. I think it takes time to really kind of get the story out there for AI, for Apple. It's something that most consumers out there are not really kind of familiar with, or what have you. I personally have an iPhone 16, and I will tell you kind of, the first tranche that we saw was essentially a non-event. The second tranche that we saw in terms of visual intelligence, in terms of kind of, their playground offering and what have you, I'm actually really excited about some of the value offerings that they have there. But again, it's a story that they need to really kind of tell out there, and really need to get consumers to really kind of adopt to it. I think, again, it's going to take time. We need to kind of get this international adoption out there. And then we'll see how they kind of, monetize this stuff. And I think this third wave is going to be really important, because you want to see what these kind of these developers out there create in terms of on the app side of things. And that's really kind of, really the biggest tranche and most important aspect of this kind of, Apple Intelligence rollout.
Well, just real quickly, though, when we get the earnings on next Thursday, Angelo, are they going to articulate that? And more importantly, do you see any potential for this stock to rebound from this big slump that it's been in correction territory, a test of that 200-day moving average today?
Yeah, I mean, I don't know if they're going to be able to articulate kind of the Apple Intelligence story enough on this earnings call. I think you kind of have to wait more towards the developers conference in June, kind of wait for that third tranche to come out, and then I think they can kind of piece the story a little bit better at the developers conference in June. But I think as far as kind of the earnings call is concerned here, it really is all about China. And if they can kind of talk, a narrative on China that isn't as bad as feared out there, and the fact that, eventually AI kind of comes into that ecosystem, that, there are partnerships potentially coming, in China out there that can maybe help the story. I think then you've got kind of the makings for a potential recovery in Apple stock. But if I'm an investor right now, I'm not overly concerned about this pullback. We're using it as an opportunity for investors to buy.
All right, Angelo, great stuff. Of course, you're going to have a busy week next week. Angelo Zino, technology equity analyst over at CFRA. Meta and Microsoft scheduled to report on the 29th. Apple scheduled to report on January 30th. When we return, we're going to take a look back at this day in history and a look back at Olestra, one of the hottest weight loss product introductions in history that quickly turned into one of the biggest product flops of all time. This is Bloomberg. All right, let's take a quick look back at this day in history. January 24th, 1996, Procter & Gamble won U.S. regulatory approval to sell Olestra, an edible but indigestible oil that could be used to fry foods without adding fat or calories to the final product. a natural chemical compound. It was discovered accidentally back in the 60s. Olestra mimicked the taste and mouthfeel of fatty oils, but since it couldn't be absorbed by the body, well, you can snack to your heart's content, in theory. P&G spent more than $200 million to develop Olestra and its branded product Olean, and it found its first major customer in PepsiCo's Frito-Lay, which rolled out a line of potato chips fried in Olestra called Wow. And wow, indeed. In 1998, the first full-year Olestra products were marketed nationally. P&G generated sales of $400 million from the food additive. But success, that was upended by a barrage of criticisms about people who claimed that the food ingredient robbed the body of essential vitamins. Even worse, consumers who bought the Wow chips and other Olestra products complained of disturbing bowel-related side effects. While P&G disputed those criticisms, public perception soured fast, and by the year 2000, sales had dropped by half. And by 2002, the company actually sold its primary Olestra manufacturing facility. While Olestra is still allowed to be used in food products in the U.S., no major items on store shelves carry it anymore, making it perhaps, Scarlett, one of the biggest product flops in history.
It certainly was, and there's a big question as to, how much longer it could have stayed on the market, although it was discontinued after 2024. All right, coming up, the folks behind the popular Earn Your Leisure brand join us live in studio. We're going to catch up with them on their latest endeavors coming up next. This is A Close on Bloomberg.
Earn Your Leisure, which includes the popular business podcast, is focused on empowering people to achieve financial freedom. Every summer, they host InvestFest, a big conference down in Atlanta, bringing entrepreneurs and entertainers together to celebrate economic wellness. And now, the duo behind the brand are New York Times bestsellers with their new book, You Deserve to Be Rich, Master the Inner Game of Wealth and Claim Your Future. Here in studio are the co-founders of Earn Your Leisure, Rashad Bilal and Troy Millings. It's been way too long, fellas. How you been doing?
Good. How you doing, man?
Let's talk about this book here. I was told today this is actually already on the New York Times bestsellers list. Give us a sense here of kind of what I'm going to learn, or maybe what someone else would learn by picking up this book.
Yeah, it's a reference point. A lot of times people ask us, where do I start? So we wanted to create an encyclopedia of sorts where you can get A to Z journey. And it walks you through from credit to real estate to stocks, but it's done in story format. It follows fictitious characters. So it really is a personal finance journey for anybody, anywhere in life, but especially people that are looking to make the next leap into wealth.
Is it harder to do this stuff now, I guess, opposed in the past? I know you guys just kind of started this business just a few years ago, but when we talk about not just personal finance, but really just getting people a better understanding of how business and economics work on a level that will allow them to actually make money and participate in the economy, what's the difficulty?
I feel like each year has gotten easier. We started the company in 2019 where people were needing the information. Since then, we've seen people actually apply the information, and what's happened is that more people have come back to receive more. And so each year, we're seeing encouraging numbers with people that are attending the events, the people that are tuning into the show, people that are opening brokerage accounts, and so there's an uptick that we'd like to see continue.
Without getting political, I'm wondering whether you think the investing environment overall has gotten more conducive under this new government to people being able to actually achieve financial freedom.
Crypto is something that has been championed by this administration. So that for sure, I think has a lot of enthusiasm amongst investors. Stocks, I think that, stocks were at all-time high during the Biden administration, and a lot of people invested when Trump was in office the first time, and they invested when Biden was in office. So I think the stocks aspect of it, we've seen the enthusiasm pretty much stay the same. And a lot of people have been investing in crypto as well, but we definitely have seen an uptick in interest and enthusiasm for cryptocurrency.
And of course, part of someone's wealth is also real estate. And I know that Romain mentioned that earlier. The wildfires in Los Angeles are a real reminder here that home ownership is very risky. It can go up in flames, and if you're lucky, your insurance will cover some of it, hopefully most of it. Extreme weather feels like an underappreciated risk when we talk about your portfolio. In places like California or Florida, do you think that financial freedom entails owning property, or does it maybe make more financial sense now for people to rent instead of owning?
Yeah, I think it's case by case. We know one of the ways to build wealth is to have ownership. But one of the things we always talk about, especially inside the book, is making sure that you have reserves. And so making sure that you have a plan and make sure that plan is updated, whether it be through insurance for your home or insurance for your life. And so these are the keys that we see inside of wealth building strategies, right? When we talk to people who have come from numerous backgrounds, they all have similar stories. So making sure that you have that plan, sticking to it, and understand how you build wealth. Yes, through real estate, but also through investing in the stock market, crypto is a new way, and creating business.
Well, let's talk about the creating business side of it, because I think particularly for Black Americans, this, to a certain extent, has been a bit of a salvation. It's kind of been the corner of, I guess, our world that we can create something, build wealth without, having certain folks knock it down. So, I don't know, maybe you could start, Rashad, and just kind of give us a sense here of what that environment for building a business is now.
It's online right now. That's how we started, was online. So technology has empowered everybody. And you're talking about artificial intelligence, you're talking about social media, you're talking about all of these platforms that has actually lowered the barrier for entrepreneurship. And you can create a business now for a low price, but it's still work. It's not, I think a lot of times people have the misconception about entrepreneurship because of social media that you start a business and you have a Lamborghini next week. That's still, it's a different model, but it's still the same amount of work that you have to. And I think other people will look at successful entrepreneurs from social media standpoint and think that it's easy and it's not real business. Like, get a real job. You hear that a lot. And they can't be farther from the truth. You run it like a real business, just like a brick and mortar business.
And I'm glad you brought up social media, because I mean that really was kind of opened the doors for a lot of folks. And I'm wondering, how much has that changed? I mean, we've been talking the last couple of weeks about the potential shutdown of TikTok. And we've also just been talking about how social media platforms overall don't necessarily have the same traction. I mean, X is not what it used to be. I know Instagram is still kind of holding on here. But can somebody come up today through the social media platforms and build a business in the way that you guys did?
Yeah, I think the signs all point to yes. The important thing with social media is that you got to still young, right? And so if we look at which social media platforms have done that, they're the ones that are becoming more successful, and more younger people are using that. We've seen plenty of people in the streaming world create million-dollar careers and businesses, not only for themselves, but for their friends and their communities. And so definitely social media is a young man's game, but it is used by everyone.
It's a young man's game, but clearly more people across generations are, definitely gravitating towards it. I know you're already in the planning stages for the InvestFest that's coming up in August in Atlanta. What do you think is going to be the theme when it comes to addressing people's concerns, the risks that are out there?
Well, I would say more so what people will be excited about. Cryptocurrency for sure, artificial intelligence for sure. Those seem like the top themes. Last year was artificial intelligence, but I have a suspicion that crypto will be a major theme in this year's InvestFest.
Bitcoin or like meme coins?
Well, there's a difference between altcoins and meme coins. We never really encourage meme coins, but there are some legitimate altcoins. So when you look at XRP has gotten a lot of enthusiasm, Ethereum for sure, Solana. So I wouldn't necessarily call those meme coins, but Bitcoin for sure. I mean, Bitcoin has always led the race, but I think that people are interested in cryptocurrency across the board. So it's about providing real information so they don't get caught up in meme coins and lose all of their money gambling.
All right, good stuff. Rashad Bilal and Troy Millings, really appreciate both of you joining us here today, co-founders of Earn Your Leisure and, of course, authors of a New York Times bestseller as well.
Thank you for having us.
All right, and these guys have done a lot to help people of color navigate financial obstacles, and that's also been top of mind for businesses like OneUnited Bank. In honor of Martin Luther King Jr., OneUnited, a black-owned bank, launched a new program for first-time homebuyers. I had a chance to sit down with the CEO, Kevin Cohee. Here's what he had to say.
Home ownership is a real challenge in today's society. It costs so much to get a home, in fact, too much. The good news is there are corporations who are interested in giving everyone the opportunity to have a home. And the particular program you're talking about is our partnership with the Federal Home Loan Bank, in which they're working with OneUnited Bank to provide access to as much as $50,000 down payment assistance.
When I saw that program, the first thing you think in your head is, oh, great. I couldn't help but also think about the fact that this was a program that was basically announced in the wake of the inauguration of Donald Trump. who has taken a lot of measures in very short order to kind of roll back some of these programs that, at least in his view, he kind of views as DEI, for lack of a better term. Do those programs survive under a Trump administration?
Well, I think definitely so. I would prefer to look at this as an opportunity. It's an opportunity to provide much needed resources to all people.
I want to talk about what your bank has done in the past, and more importantly, what it could potentially do in the future. Most people associate your bank with Boston, but you have a big presence down in Florida. You also have a big presence in California. We've seen several communities in California decimated by the wildfires. There's a lot of talk about Malibu and sort of the wealthier areas. Altadena, California was ground central. A historically black community. I was taking a look. The black homeownership rate in Altadena, California was something like 80%. That's more than double the national average. Those people now don't have homes. You have some celebrities like Beyonce pledging millions of dollars to help rebuild those communities. Will your bank be a part of that?
Oh, absolutely. It's what we were born to do, is to be able to be there in those types of situations, to be a source of financial strength to help our communities to grow and prosper. And so the good news is, as you mentioned some of the markets that OneUnited Bank operates in, but OneUnited Bank is a nationwide bank. We have customers literally in every single state. California happens to be our biggest market, and our company was designed to be able to be a source of strength in situations like that. You're absolutely correct that there were historically important black communities that were decimated by this catastrophe. We've already reached out to our partners. OneUnited Bank has, because we have the relationships with the JP Morgans, the Citibanks, the Googles, and these types of corporations, we're able to access resources to bring our partnership to bear in really challenging situations. So we will definitely be a source of strength in rebuilding these communities. America is a big, growing country with vast financial needs. So our financial needs can't be serviced by just one type of provider. Banks do very different kind of things. Like OneUnited Bank we're an FDIC insured commercial bank, to be clear, but we're also a financial technology company. The reason the company has grown so fast and we have such a large breadth of customers is because of our technology. That's what's unique about us. Our data aggregation technology is second to none, i.e. our ability to pull together all your financial information no matter where it is, so you can actually literally understand on a real-time basis where you are financially. The thing about that just in and of itself, and then that's coupled with our artificial intelligence technology, which, by the way, we've been working on for over a decade, which takes that same information and helps you to make better financial decisions on a real-time basis. So I'm just using this as an example to show you how very different banks can be, how very different and kinds of financial services are needed and can be provided. So I think that there's going to be a continuing and, in fact, a growing opportunity for financial services providers as our country continues to grow and prosper.
Kevin Cohee there, CEO of OneUnited Bank. Some excerpts of our conversation that we had yesterday. And Scarlett, I mean, we talk about this being the largest black-owned bank, but it's still relatively small in terms of overall deposits, at least when you put it up against, the JP Morgans and even some of the big regional banks. And I asked him a lot about that, is kind of what's the role of a community bank these days? And he kind of actually drew on the wildfires and saying these were the types of situations where community banks, particularly CDFIs, really play a big role.
And he knows his customers, right? His customers can go to him directly. If you are a customer of a big bank, it's harder to go up to one of the branches and say, here's my story, I need some help.
Yeah, absolutely. Well said.
All right, let's take a look at what's going on when it comes to the financial markets. For the week, stocks did end higher on the day, however, it was a little bit of a petering out towards the end of the week. We retreat from a record high, first decline in about 5 days. Semiconductor stocks in particular under pressure. Texas Instruments was the latest to give a forecast that disappointed. It really puts the onus on the chip sector going forward, especially as we get the big tech earnings next week. And dollar yen remained dollars weaker versus all the major currencies because the BOJ raised rates.
I'm actually fascinated by this. I thought this was a big story in 2024. I think Japan and the yen and everything Ueda is doing or may not do is going to be the big story this year as well.
Yeah, well, they chose to wait to see what happened with Trump, and since no tariffs came forward, they raised rates. This is The Close on Bloomberg. We are nearing the end of Donald Trump's first week in office, and two Biden-era appointees continue to show up to work. The heads of the Consumer Financial Protection Bureau and the Office of the Comptroller of the Currency, they're still serving in their roles, despite calls from Trump allies to overhaul these agencies. I'm pleased to say we are now joined by Rohit Chopra. He is director of the CFPB in Washington. Rohit, thank you so much for joining us today. Has anyone from the Trump administration reached out to you? Are you surprised that you haven't been replaced or asked to leave?
Well, look, I understand it is a tough decision to figure out who should take the CFPB. It's an agency that has recovered billions of dollars in the past few years from bad actors, including some of the biggest banks on Wall Street. And there is a well-funded opposition to the agency itself, and many people would love to see it burned to the ground. So I'm just doing my job each and every day, and I want to make sure that when someone is chosen, there can be a smooth transition. We've put into place so many different initiatives that we think my successor could carry the torch with to take on some of the exorbitant credit card interest rates and fees, to tackle the issue of debanking, which has raised so many concerns, and just so much more. So I'll keep serving my 5-year term unless I hear otherwise.
If you were asked to stay for the entire 5 years, the term, or if they don't say anything to you, would you be willing to serve your entire term? I know that Richard Cordray was the last head of the CFPB under President Obama, and he served his entire 5-year term, which extended into the first Trump term.
Well, I don't want to comment on any discussions. I think what's important is that we have put into place a plan so that we can make those handoffs. And what's so important is that there are so many issues on which there's broad bipartisan consensus. The way in which some banks and financial companies have ripped off people, have scammed them and defrauded them, they need to be held accountable. We heard yesterday President Trump call out the CEOs of Bank of America and JP Morgan Chase for closing people's accounts or not doing business with them. The CFPB has already proposed a rule to make sure that there is not discrimination based on political views or speech when it comes to people's bank accounts. So I think there's a lot of work that just needs to get done, and whoever is in this seat needs to be able to stand up to that very well-funded opposition who is trying to delete or defund the agency.
That very well-funded opposition, Rohit, is in the White House. I mean, I'm just a little confused here. I mean, I understand, and I applaud your sense of duty to your job, but you have a president who made it very clear on the campaign trail his, lack of love for your department. He's putting people in place in other cabinet positions that have made it clear they have no love for your department. So even if you are able to finish out your term, do you think that you can effectively get anything done, or at least anything done that you want?
Well, like you said, I swore an oath to discharge my duties. I'm responsible for policing large banks and other financial firms to make sure they don't run a repeat of what they did in the years leading up to the financial crisis. Just a few days ago, we recovered $175 million from Cash App for their role in facilitating fraud, and we've taken big action. So, Romaine, we'll see what my successor will or will not do. But based on what I'm hearing, I think there's a lot of issues where President Trump has seen that consumers do need to do something. The the very high credit card fees and interest rates, the issue of data brokers who are ingesting all of our personal data. But look, I'm ready to hand off the baton whenever, and I'm just going to keep serving until I have someone to hand it off to.
What can you talk about any specific proposals that you might sort of put out there under a Trump umbrella, assuming that you do stay on the job for another year or so? What specifically would you do that you think would actually pass muster with the White House?
Well, look, I'm looking to make sure that there is a smooth transition to whoever is going to take over, and I'm hopeful that that person would carry on some of the really solid work we've been doing to take on illegal junk fees that have been draining people's bank accounts. Sometimes you're getting charged for things that are ridiculous, that you never signed up for, and don't even provide any service. We've done so much when it comes to credit report accuracy, including the scourge of medical bills that are parked on credit reports to coerce people into paying bills they don't even owe.
Rohit, just real quickly, though, have you met with anyone from the Trump administration?
Well, we are always trying to make sure that when the transition wants to talk to us, there is protocols that are set up during a transition, and we are always responsive to that. But at the end of the day, it is important that there be a smooth handoff to whoever takes this. And I'm really hoping that this agency will continue to do the job that Congress set out for it after the financial crash. It's just too important to the public and our markets. And a CFPB that is not doing anything, that's just a recipe to bait a financial crisis or allow fraud to spread.
Before I let you go, just really quickly, is that your pitch then to the White House if you were to stay? I mean, have you made a pitch to them?
No. My job is to make sure that I'm discharging my duty and to make a smooth handoff whenever they are ready. Whether it's today, tomorrow, a few days later, whenever it might be, it is important that the CFPB aggressively protect consumers. Romaine, I hear you that you're skeptical, but I need to do everything I can to make sure that these important initiatives persist.
All right, Rohit. Well, we appreciate you taking the time. And once again, I do applaud your sense of duty. Rohit Chopra, the director, current director, maybe outgoing director, maybe the staying director of the CFPB. Stick with us here on The Close. We're going to take a quick break, and we're going to set you up for what to watch next week. This is Bloomberg. As we wrap up a busy week, we'll push ahead to maybe an even busier a week. A lot of earnings on tap, as well as some big monetary policy decisions.
Yeah, but let's start with earnings, right? We've got AT&T and Nucor on Monday, and then we do start to get the big luxury houses in Europe on Tuesday.
LVMH, of course, set to report on Tuesday. That could be interesting. You'll get a nice read on the U.S. side on consumer spending with Royal Caribbean and Starbucks. But let's talk about those tech earnings. That starts on Wednesday.
Yeah, and it's also hump day. We've got the Fed decision. We've got almost half of the Mag 7, Microsoft, Tesla, Meta, all reporting on that Wednesday.
And of course, that is in the mix with Jay Powell and that Fed meeting Thursday. We do get Apple, Intel, Visa, among others, and a great decision out of the ECB.
Yeah, they're ready to cut. So we'll see how that all plays
Let's hope
out.
So. Well, and then on Friday, we get a big inflation read here in the U.S.
The PCE inflation data, that's what everyone's looking at, especially with renewed concerns about inflation picking up.
Scarlett and I will be back next week for all your market-moving coverage. For your political news, stick around. Balance of Power is up next, right here on Bloomberg.